Welcome to another edition of Your Wealth Matters and our first quarter update for the year 2022. I'm Janet Kim Singh, and I'm joined by my fellow portfolio manager on the private wealth team, Maria Dawes, and later we'll be joined by a special guest, Mr. Cecil Hayes of the MarshallZehr Group, a key service provider to Capstone's mortgage investments. First, though, let's do a recap of what we've seen in the past quarter and then look ahead to what we might expect to see for the remainder of 2022. And as a special update, Capstone's President and Chief Investment Officer, Glenn Murray, has recently returned from a due diligence trip to Rwanda, the geographic region in which we will be looking to invest through our newest fund focused on impact investing. We hope to have some more exciting updates about this latest fund in our next quarterly review. But for now, Maria, would you like to give us some initial comments as to what we've seen this past quarter from an economic perspective?
Thank you, Janet. I'd be happy to. We have certainly seen some volatility in the traditional markets during this first quarter, and this has been the result of a variety of factors, but most notable to most includes significant inflation. In fact, this has already led to the beginning of the rise in interest rates in both Canada and the US. Inflationary pressures have been further intensified by the continuation of demand and supply distortions, which are the legacy of pandemic protocols, as well as the war in Ukraine. I think it is well understood, Janet, that there's a lot of work to be done to get interest rates up to a point that inflation begins to slow and the red-hot housing market cools. But there's a price to pay for that too. And we're already seeing that in the volatility of the traditional bond market and much more expensive debt payments. This is a very brief summary of what is happening today, Janet, but did you want to add to that and then segue into what we're expecting to see as the year progresses?
Yeah, that's a challenging question, Maria, given that the future of the economy, of the markets, especially now in this time of heightened uncertainty, are predicated on so many moving parts. But I think you're right to say that we're in a fragile environment, which has been the case for a while now, going back to the beginning of COVID-19 in early 2020. And even though the worst of COVID seems to be behind us, with some recovery in the labor market numbers, Canada's trade balance continuing to be positive, yet the ramifications and impact to businesses will be felt for quite some time, with recoveries being uneven across sectors since these have not been impacted equally. The size of Canada's debt load for sure will be an ongoing drag to economic growth in the longer term. And of course, we would be remiss if we didn't mention the current situation with Ukraine. And I don't want to go down too much of a rabbit hole, but I think it would be an injustice if we swept it under the rug. I do have to say, I personally never thought that we would see this level of destruction, war crimes, and even genocide in this day and age. It is absolutely heart-wrenching to see and hear the stories of all those being impacted, lives lost and families displaced. And as a direct result of this war, there are a lot of sanctions levied against Russia, causing significant economic turmoil there. The impact to us in North America, however, is that this situation will likely exacerbate our already existing supply and demand issue. Additionally, this could lead to even worsened or extended inflationary pressure, particularly in relation to food and energy prices. So don't be surprised if we see these deteriorate further rather than improve. This geopolitical instability certainly adds to the overall level of general uncertainty that is already being felt on the home front, but also in the markets as a whole. For now, this remains a developing situation with the potential for continued global consequences. I'm sorry if that sounds very doom and gloomish, but that is the current reality that we are in.
That's right, Janet. One thing that we can know with a high degree of certainty is that interest rates are officially on the move. And in addition to that, the Bank of Canada has also ended its quantitative easing program so that we are now moving on to the reinvestment phase. This means that the bank will purchase Government of Canada bonds solely to replace maturing bonds, and this should also serve to increase those interest rates on short and medium-term bonds. In the US, we also know that the Fed intends on reducing its balance sheet, which currently sits at nearly $9 trillion. It is expected that this eventual reduction will serve to tighten monetary policy and bring inflation back under control there. But back to interest rates. We saw the Bank of Canada execute their first rate hike in March, and it is predicted that several more will occur before the end of the year. This first one was a modest 25 basis points, but now in April already, we have seen an additional hike of 50 basis points. So that brings us to 1%. But don't forget that the Bank of Canada rate was at 1.75% before the pandemic. So it is reasonable to assume that we have a ways to go still. But what are the effects of these hikes? Many are predicting these increases in interest rates may serve to cool the housing market, but only time will tell whether that turns out to be the case because we still have a pretty serious supply and demand imbalance. For that reason, higher rates may not actually cool the market down all that much. And speaking of interest rates and the housing market, it might be a great time to introduce our special guest, Mr. Cecil Hayes. Cecil is the Chief Operating Officer at MarshallZehr Group in Waterloo, Ontario. MarshallZehr has served Capstone for over 10 years as the administrator for its mortgage investments. Thank you for joining us, Cecil.
Yes, it is great to have you here, Cecil. Today, we'd like to talk about how Capstone Asset Management and MarshallZehr work together and what your role is as mortgage administrator. And then to wrap up, perhaps we could ask for your insights regarding changes in interest rates and how that could affect the current housing market. So, Cecil, why don't we begin by asking you to define the relationship between MarshallZehr and Capstone?
Thank you, Janet. It's a pleasure to be with you this afternoon. Just to take a minute and go back to the beginning of that relationship, we started partnering with Capstone and Glen Murray in 2012. We formally entered into an arrangement as the mortgage administrator on the Capstone mortgage pool. And at that time, Capstone was looking for an alternative investment strategy to produce high yield for the income portion of the portfolio. And some searches have been happening for a period of time to find a mortgage administrator that had similar values and approach to the business that Capstone had, where you could feel comfortable with a long-term partnership there. The role of MarshallZehr as the mortgage originator and administrator is multifaceted, where we source transactions, do the initial underwriting of the projects to figure out profitability and the structure of the capital stack. And then within that model, there's a portion of that capital stack that typically fits the investment mandate of either Capstone Mortgage Pool, the Capstone Mortgage Opportunity Fund, or the Capstone First Mortgage Fund. And in some cases, there's overlap there where it would be a mandate for two or more of the funds. So the mortgages are put in place to meet the needs of the borrower, and then we figure out in that capital stack what's a fit for the funds. At that point, we have approved the mortgage at MarshallZehr's credit committee as a transaction that we're supportive of, and then we go out to syndication, and that's where Capstone's team on the portfolio management side gets involved, where we would send over an initial lender package, and the portfolio team does a review of that to determine if it fits the investment mandate and the needs of the fund, and go through their specific underwriting and questions. And they do a full underwriting of every product that's held in Capstone's funds, and make a credit decision on that, and come back and commit to MarshallZehr for a portion of the funding of whatever transaction that we're doing. And that's the first stage of origination. And then beyond that, after the initial funding, MarshallZehr takes on the role as mortgage administrator, which on the day-to-day basis involves calculating the NAVs, the asset values for the mortgage portion of each of the funds, providing ongoing reporting of that. But more importantly is the project management function, where we're continually in contact with the borrower who's building out the project to manage the progress on site of the projects, to do reviews of monthly draw requirements and review the budgets and make sure that the project continues to operate within the confines of the contract that was entered into by Capstone for credit. So we manage that project through the process of monthly advances through construction, and then the final and the discharges that happen at the end of the mortgage, and ultimately the return of capital back to the fund. So that relationship, once we start on a project, actually follows through on a daily basis through a cycle of the term of the mortgage, whether that be a 1 year to a 3 year term of development on site. And that, in a nutshell, is really the orchestration of how the partnership works together.
Thank you, Cecil. And in your opinion, can I just ask, what impact do you think will a rise in interest rates have on the housing market as a whole? And if I may, a part two to that question, how correlated would you say is the type of lending that we do to interest rate changes?
Yeah, it's a little bit of a loaded question that everyone's dealing with right now. Obviously, it's and it's multifaceted. So the interest rate increase affects our end buyer, and typically on the sold product. So a large portion of the Capstone fund holds mortgages for the construction of sold units, so condominiums and homes that are sold to an end user before the construction starts. So we need those buyers to continue to be approved for their financing on exit to close. So in the short term, a lot of work has already gone into mortgages to make sure that the purchasers are qualified purchasers and their deposits are in place and they qualify for mortgages. There's not a lot of risk in that part of the portfolio. I think the aspect that everyone is looking at is how much will increases of interest rates impact the purchase prices of real estate in urban markets in terms of the escalation of prices. So for example, even here in our local market in Kitchener-Waterloo, which is somewhat of a tertiary market to the GTA or Vancouver, would be similar if you looked at at an Abbotsford or Richmond community. We saw price escalations in the resale market of over 30% in 2021, which is not a sustainable pace for real estate to grow at. So we're expecting some leveling off. My view is that a modest rate of increases of rates of 50 to 250 basis points will slow that pace of growth in the market. I don't see it causing prices to pull back dramatically because there's other factors in the marketplace, primarily around shortage of supply, that are driving the prices that we're seeing right now. Is really just a lot of competition for every bedroom that becomes available for purchase effectively. So I think in the short term, some rates will smooth that curve out and it will cause a more normal growth pace there, but it doesn't deal with the supply issue at all. So, I often joke, and it's not really that funny, but in Canada, living outside is not really an option given our weather patterns. So everyone needs shelter. Everyone needs a place to live. Immediately after they satisfy safety and food security, then housing is very important. So whether people have to go together in larger family units or whatever they need to do to provide housing, they find a way to solve that problem. And just the sheer demand, particularly in Vancouver and Toronto and in hot intake markets, where we're seeing both immigration and migration within the country into those marketplaces, there's just simply not enough houses being built and brought online for the growth in the population. So that pressure continues to be there. Obviously, qualifying for mortgages is a big impact on people. So if you have even a modest increase rate now of 200 basis points, really doubles the cost of carrying for a mortgage. And I think the last mortgage I took at home was 1.29% variable rate on a closed 5-year term. So 150 basis points more than doubles my monthly carrying cost on interest. And that's a pretty significant impact for individuals. So if rates continue to go out beyond that 200 basis point increase, I think it'll put a lot of pressure on the marketplace in terms of people qualifying to purchase. What does that mean for MarshallZehr? Is our focus really turns to more emphasis on rental stock for purpose-built rental products, and also a continued focus on housing that's affordable to normal, and normal is maybe not the right word, but sort of the standard economic household. So I'm not saying affordable in the terms of affordable housing and government-backed projects. I'm talking about financing projects where the targeted purchaser would be, a normal couple in their 30s where husband and wife work outside of the home in modest to normal jobs, where we're not looking to build homes that are only attractive to the affluent part of the marketplace or the top 5% of the market. So we've always focused on that core of common housing product in terms of townhouses, modest single family homes, apartment buildings, condominiums that are in communities where working class people are buying homes. So we continue to focus on that. From a risk mitigation perspective, there's much more focus in a market like this on the qualification of the purchaser, as we talked about before, the quality of the deposits. In other words, is the deposit level for the purchase high enough? And are those payments on deposits, if they're on a payment plan, are they being met? Or are there any defaults on the payments to deposits? We also run a breakpoint analysis on anything we're underwriting. So in the current underwriting, we have a 12-month term on a mortgage that we're looking at. We would be contemplating 7 interest rate increases during the term of that mortgage of a quarter point or 50 basis points, and calculating where the profitability will come in. In other words, can the project afford an increase in interest rates that's in line with what we expect to happen in the marketplace? And certainly post-election in Ontario, there's always some concerns about what a government does when they have a mandate for a period of time in terms of those things. But obviously interest rates are a federal decision, and a lot of that is being driven more by the inflation we're seeing in the marketplace caused by fuel prices and other costs like food increases. So it's a moving market. We actually feel that some modest increase in rates will stabilize the market to our benefit. It typically will drive out some of the purchasers of land in the development space that are less experienced or less well capitalized. So the quality of borrower in a tough market tends to improve in terms of the opportunities that we're seeing. And a little bit of a shakeout in the industry is also good, just to keep the quality there in the people that we're dealing with. Obviously, that's different than hyperinflation, which is something that, you know, if that were to take place in Canada, our problems would be different than what we're dealing with here. But I don't think anybody really foresees an increase that would be significantly more than 250 basis points in this cycle.
Thanks, Cecil. We know you are very busy, and so we appreciate the time that you spent with us today. Thank you so much for joining us.
It was my pleasure. I look forward to speaking to you again. Have a great day.
Thanks, you too.
Thank you.
So Janet, key takeaways, not just from Cecil's comments, but overall?
Yes, it is in this environment of uncertainty, the old saying that diversification is king certainly holds true. We might sound like a broken record, but that is the best way to protect your portfolio as well. And as we mentioned on our last quarterly review, trying to time the market is not a good investment strategy, but we should remain exposed at a level commensurate with our risk tolerance. This means maintaining the proper balance between both traditional and non-traditional investments will lower the volatility and smooth out return profiles, and trying to shift our focus based on long-term risk rather than just expected returns for 2022.
I agree. Thank you for joining us today. We hope you've enjoyed our update for the quarter. Please stay tuned for our next edition of Your Wealth Matters next month. And as always, please feel free to reach out if you have any questions or comments. Bye for now.